If you want to learn how to purchase the most amount of properties in the least amount of time, then this video is for you. Hey everyone, welcome back to my channel. My name is Manjit Rukhra, and in this video, we're going to be talking about one of the most exciting topics in real estate, which is leveraging other people's money to buy properties. Now, in the context of this video, we're going to be talking about debt deals versus equity deals when buying properties to rent and properties to flip. Now, let's start with the basics of understanding debt deals. Now, at the end of the day, a debt deal is something that you're borrowing money from, or someone you're borrowing money from, and paying interest on that money. Now, a debt deal can consist of anybody like a private lender. So this could be your mom, your dad, your brother, your coworker, somebody that knows you, somebody that you have a relationship with. This can also be a hard money lender, meaning this also acts as a private lender, but in the context of using an institution or using a mortgage broker that connects you with other private lenders in their network. Now, the difference between doing a debt deal when it's a private lender in your network versus a debt deal using a private lender through a mortgage broker is the mortgage broker or the private lender through a broker is going to charge you a little bit higher of a fee. Now, let's say the standard deal is where you're paying 10 to 12% per annum on the money. You borrow $100,000, you're paying 10% on that money for the whole year or for 6 months or 3 months. Now, when it comes to a private or a hard money lender through an institution or a mortgage broker, where they're going to charge you probably 3 or 4% more on average. But not only that, they're also going to charge you points, or what we like to call, I call it the kiss the ring fee, which is just the cost of borrowing the money. Now, usually in the industry, we call this points. This could be 1 point or 1%, 2 points or 3 points. Now, if you borrow $100,000, let's for simplicity's sakes, and they want 3 points on that money for you to borrow it, where you're going to be paying $3,000 on the 100,000, which equates to 3% on the 100,000. And again, if it's 250,000, 3 points on that. Now, this is in addition to you actually paying a 10 or 12% return on that money. So keep that in mind. And essentially, when you're taking out that debt loan using a private lender or a hard money lender, well, you're gonna have to repay that back. Now, the two ways that we have used money like that in our business is to fund our short-term flips. We buy a house for $300,000. We require about 75 grand of renovations. We also need to spend another, say, $10,000, $15,000 for what we call holding costs, paying the utilities, paying the land transfer tax, paying the staging on it. And so all of this, we're going to be using that as debt. We're going to be using that money from a private lender, somebody in your network, or using a mortgage broker. Now, that loan's going to be repaid when obviously you sell the house and you take that money, the lender gets paid back first, plus the interest that has accumulated, and then the difference goes to you. Now, debt deals or private loans can also be used to fund your rental properties, where you buy the property just like you would if you were to flip it, you renovate it, but now because you bought it low, you renovated it, you increased the value, or what we call you forced the appreciation up, you can go to a bank and the bank will give you a loan on that mortgage, a new mortgage, 80% loan to value. So if you bought it at $300,000, you put $75,000 of renovations in, and let's say you're into it for $400,000 with closing costs, the utilities, all of that other stuff, and now the property's worth, say, $550,000 or $600,000. Well, the bank's gonna give you a mortgage on the $550,000 or $600,000. 80% of that is going to come to you in cash. And what you're going to do is you're going to use that money and you're going to pay off your private lender. You're going to pay off your debt on that deal. And now the loan is repaid. And so this is a great way for either flipping properties. This is a great way to fund your buy, renovate, refinance, and rent. You know, what we call in the industry, you're burring a property. So essentially, when you're buying a rental, you're basically, instead of selling it as a flip, you're just flipping it to yourself. That's the way that I see it. So that's how we've used debt deals, private lenders through mortgage brokers, and how you guys get into. And debt deals, they offer many advantages to the owner. Well, one is because you're borrowing debt, you have full control over that property. You own that property. That property is usually in your name, especially if you and the private lender have a promissory note on it, which basically says you promise to repay that loan when the property is sold, or when you, say, get a mortgage on it and you keep that property, right? So you're doing that. Also, you're not sharing the equity with your lender, right? Unlike a partnership, which we're going to be talking about in this video, you're doing a joint venture, you're doing an equity deal. Well, you own the property in a private deal when you're using equity. That's one of the advantages. The other thing is too, if you set it up properly, depending on where you live, you can use the interest that's paid on that loan and use that to claim taxes, meaning you can actually write off the interest. The interest is tax deductible. Now, again, we've done this and we've used the interest that we've paid, either if we're paying that interest on a monthly basis, or if we pay the interest at the end of the loan, what we call a balloon payment, we can use that to lower the taxes that we have to pay on the profit on that deal. So again, great thing to keep in mind when you're doing these kinds of deals. Now, my other point is doing deals with partners, or what we call in the industry, equity deals. Now, equity deals are another great way of buying properties. And again, you can do this to flip properties. You can use equity deals or equity type of structures to even hold properties for the long haul. Now, instead of paying a loan, or whether you're paying an interest, say 10 or 12%, instead of doing that, you're forfeiting paying an interest and having ownership of that property, where now you're going into a beneficial ownership with an equity partner, or what we call a joint venture partner. You find a property, whether you're flipping it, they provide all the cash. If the deal, again, if it's $200,000, $300,000, they're providing all the cash, they're providing the renovation money, and you're not paying any interest on that loan because they are considered a partner. But when you go sell the property, you're going to be splitting those profits 50-50, 60-40, depending on how you structured that deal. Now, when I got started back 16 years ago, we actually did more of these equity deals over debt deals because I didn't have that track record. And also, I wanted people to basically build a reputation. I wanted to build a reputation with people where I showed them that, hey, by the way, I'm buying this deal, and one of the ways that I'm going to show my value or my trust is I'm going to split the profit with you, right? Today, we don't do that because we have a track record, and we don't like giving up 50%. If we make a 75 or 100 grand on a flip, well, I don't want to be sharing that with my partner. But in the beginning, we used a lot of this structure a lot, especially where we were gaining traction, we were building momentum, I was building a name for myself in our market. So this is a great way to do it. And also, you don't have to worry about having to pay interest on the money, especially if you're just starting and you don't have a reserve fund built up in your account where you can pay the interest on a loan, on a private deal, on an equity deal, on a debt deal. It makes a lot of sense. The other part is, if you're doing a equity deal where you're having a partner, a 50-50 partner, well, these are great for especially long-term rentals, right? You might be in a stage in your business where you already own 1 property, 2 property, maybe even 5 properties, and the banks told you that, hey, you know what, based on your income, based on your assessment that you're paying taxes on, we don't feel comfortable giving you any more mortgages. Now, this is where we have brought in equity partners where they go on the mortgage, they go on the title, and we own those properties through a bare trust agreement. Again, I've done videos on that, which I'm going to link up at the end here. And again, you can do these structures, and it's a great way to own multiple deals, or even do multiple deals where you're not worried about paying interest on the loan. They're actually an equity partner. The other thing I like about equity deals is you're also not taking on all the risk of buying the property yourself. You're splitting the risk. So instead of, unlike a debt deal where you're the owner, you're borrowing $100,000, $200,000, you're paying 10 or 12% on the money. Well, guess what? If that deal goes sideways, that's all on you to pay that loan back. Now, versus equity deals, you guys are sharing the tax benefits, you're sharing the profits, and you're also sharing the risk. So again, there's a lot of advantages too. And today, this is one of my common ways of actually buying multifamily properties, is by finding partners that have good income, they can get mortgages, they have mortgageability, and they can go on these mortgages and titles, and we own these properties through a bare trust agreement where we still own 50 or 60% of the properties that we buy. So again, those are some of the ways that we've used debt and equity deals to fund our flips and to fund our long-term buy and holds. Now, you can also do this if you're in construction, you build infills. It's the same concept. At the end of the day, you have to ask yourself, what are you trying to accomplish? Are you trying to mitigate the risk, and are you trying to spread the risk among other partners? Well, then you might want to become an equity partner, or what we call a working partner, where you find somebody to share the responsibilities of that deal. Now, if you're also maybe a little bit more aggressive, you have some more experience, and you want to do multiple deals, and again, you have reserves to pay back in case things go sideways, well, we would recommend doing a debt deal where you have 100% ownership of that property, and you are owning that entirely. At the end of the day, these are some things to consider, and it's not like one is better than the other. They both have their advantages and disadvantages. This is what I love about real estate. You can be as creative as you want. Now, if you guys like this video, I'm gonna link up another one here where I break down some of the best strategies that I have used to fund our long-term and short-term, and where to find these kinds of individuals, and what sort of investments that we have used, whether it's equity, whether it's underperforming investments, whether it's moving their lines of credit over to us, and how we have funded our properties the best way. So again, if you guys like this video, you definitely want to click on the next one.